Your article touted the One Big Beautiful Bill Act as a major boost for U.S. manufacturers. From an OEM's perspective, specifically machine builders and system integrators, what single provision within the OBBB do you believe will have the most immediate and significant positive impact on the bottom line? And obviously, if you could explain why you think so.
Sure. Mike, there's a ton because in my opinion, there's always winners and losers within tax bills. And domestic manufacturing was certainly a winner in this tax bill. But if I were to point to one single provision that's going to have the biggest impact on the listeners and the readers of your magazine, it's the research expensing, the ability to deduct R&D expenses as they're paid or incurred if the research happens in the United States. Tim, wouldn't you agree? I mean, that has to be the biggest.
It for sure is. Dealing with a lot of system integrators in my book of business. This one was a huge win for them, especially because before we were capitalizing these costs and having to amortize it, and instead of being R&D credits being able to reduce your tax liabilities, these R&D tax credits and expenditures basically increase your tax liabilities for the last 3 years. So this is going to be a huge cash flow win. I think most importantly, and it's also, though, we really need to understand what is in this R&D expensing, right? You have a few options that you would be able to do. Some companies that are under $31 million can go back and amend tax returns and get money back that they paid in previously. The question for that is going to be, with the IRS being understaffed, is that going to be the right thing to do? Because it may take 2, 3, 4 years to get your money back that way. Otherwise, in 25 or 26, you get to expense all those previously capitalized amounts. And going forward, that will help with reduction both in your income as well as having those credits to offset even additional income in your business. Some of the things, though, you have to make sure of as you're looking at this, again, is what qualifies for the R&D, and people have been or have not been taking advantage of the R&D, and it's still really focused on, your prototyping, pilot models, what are you doing that is new and unique? And the good thing about, as we've talked in the past, system integrators or wrote in the past, is each machine, that they're building or each cell that they're doing is usually unique. It's different for each company that they're doing it for. So that's a huge opportunity there, as well as those machine builders and system integrators, can be having those conversations with their customers that effectively, if they're doing these big machines and they're installing them, before the end of the year, people can take advantage of the bonus depreciation that came back. Right. So, for us, really looking at the R&D stuff related to system integrators. Mike, anything else to follow up on that?
Yeah, I mean, what the bottom line is, the OBBB gives you options, right, to take advantage. I mean, take a $15 million integrator. Their R&D expenses could be $3 or $4 million, and those $3 or $4 million had to be capitalized. And if you think about it from a 22 through 24 perspective, in that example, you're probably sitting on about $4 or $5 million of unamortized costs, things that you paid for, but you didn't yet get the tax benefit of. And now I get to catch all that up in my example. I could go back and amend and get refunds to the tune of north of $1 million, given that type of $5 million capitalization amount. But it's not the right answer for everybody. What happens if I'm an S corporation and I have 70 shareholders? Do I want to go back and amend 210 returns? To go back and claim that? So I might decide, no, I'm going to elect to claim all that deduction in 2025. So there's a lot of moving parts because those deductions are going to have impact on other items on your tax return, whether or not you can continue to take advantage, whether that creates a carry forward or a carryback opportunity. There just has to be a lot of diligence before we go back and, hey, we're going to go back and amend and get these refunds, right? So you want to kind of think through the process and make sure that you're taking advantage of all the benefits that the law provides for, because they specifically wrote in transition rules so that the companies could take advantage of this right away.
Right.
It never should have seen the light of day, frankly.
I think the other point that you make on that too, yeah, I mean, you got to look at state taxes as well, right? It could have a huge impact on the amount of time it's going to take to amend tax returns. Could be way more than you thought from a cost standpoint that you're going to have to do, rather than just waiting and expensing in the current year. And I think a lot of our clients that we've been talking to already, you know, we basically said, yeah, if we're going to expense in 25, guess what we don't have to do for the rest of the year is make any more tax payments. So, you know, it's nice from that standpoint. They're like, oh yeah, that makes it nice. I now have that cash that I can either distribute out to the partners themselves and they can use it themselves, or you put it back into the business to, you know, grow what needs to be grown.
Right. Yeah, it sounds like a lot of moving parts, and the solution isn't one size fits all. Really depends on the organization, the way the organization is structured, and who the investors and the shareholders or the stakeholders are within the organization as well, and the impact that the taking the advantage will have on them.
Yep.
So, next question: with the 100% bonus depreciation permanently restored for new equipment and the enhanced Section 179 expensing, what advice would you give to OEMs regarding their capital expenditure planning for the next year or two? And are there specific types of investments that become particularly attractive now?
Yeah. So the you know, these provisions in the OBBB are very capital intensive favorable, right? And that's why manufacturing is one of the big winners here. We've got kind of 4 different areas to accelerate otherwise deductions that I would be capitalizing and I wouldn't be getting the benefit for future tax years. Because generally speaking, a commercial building, if I go build a manufacturing plant, the general rule is I depreciate it over a 39-year life. So if I go out and I buy a $3.9 million building, I get a $100,000 depreciation expense each and every year. Well, what they've done is they put 100% bonus depreciation in, and there's a wrinkle there, because if I bought a piece of equipment in December and I signed a contract to sign a piece of equipment to purchase that piece of equipment in December, and it sits on a boat and it comes over and I install it in February. Well, you might think, well, boy, it was after Trump was inaugurated. I get 100% bonus depreciation. That's when I placed it in service. But that's not the case, because I had a contract prior to January 20th. And because I had the signed contract, a binding contract before January 20th, I'm under the old depreciation rules. But 100% bonus depreciation, extremely welcome. I mean, that's going to cover 100% write-off of your machinery and equipment, leasehold improvements. If you're putting clean rooms in, those can all qualify because it's qualified improvement property. Any type of interior improvements where I'm not expanding the square footage of the building. If I'm building different manufacturing cells, these are all things that would qualify for the 100% bonus depreciation. And, you know, I often get questioned, well, Mike, why do I care about 100% bonus depreciation if I got Section 179? Or why do I care about Section 179 write-offs if I've got this 100% bonus depreciation? And the answer is because different types of assets qualify for different buckets. So like a roof, that's a 39-year asset. That doesn't qualify for bonus depreciation, but it does qualify for Section 179. And if I'm under those thresholds, you know, I can write off up to $2.5 million. That's the new threshold for Section 179. Mike, when I first started in public accounting, the threshold was $16,000. You could write off $16,000, and now it's $2.5 million.
Right.
So drastic change, right? From over the last 30 years of what you can write off immediately. Speaking of Section 179, there's a 179D piece of it. So part of your question was, are there specific investments that they really need to look at now? It's the energy efficient ones. Let's say I'm going to put in energy efficient lighting or energy efficient HVAC or an energy efficient roof or building envelope or exterior walls. All of those things have specific accelerated depreciation based on the square footage of the building. So if I put all those components in and I use standard of wages, basically union wages, in order to put those systems in, I can be eligible for up to $6 per square foot of accelerated depreciation. But all the construction has to begin by June 30th of next year. because they rolled back all these energy credits, and this got rolled up into one of them. And then, the final piece is this whole new factory write-off, the 100% write-off of new facilities.
In the machine builders and system integrator area, there's a lot of the system integrators that do some electrical work or some other stuff, and may even be installing HVAC systems. And if they're doing that for not-for-profits, there's a huge opportunity that they can basically get allocated this $6 per job that they're doing. For square footage of a building and different things like that. So they could get an additional deduction that's a permanent type difference that they didn't know about. There's one smaller system integrator that I was talking to that does some boilers and different things like that for some schools, right? And so we're now looking at whether or not they had that school already allocated this Section 179D or not. But if not, then potentially they can get some basically free money. That would be deductions that they would get on their tax return. And it's something that Wipfli does internally and can help with. So if anybody is out there thinking about that, it's a huge opportunity. And as Mike said, the problem is this one's going away. So if you haven't started that construction, by 6/30 next year, then that 179D will no longer be available. But even on that too, you can still, and that was in this bill prior to, but you can still go back and look at old jobs that you did if no one allocated it, and potentially get some of that money as well.
As you started to allude to there, Mike, the OBB does introduce full first-year expensing for qualified production property facilities. So for an OEM considering expanding or modernizing their U.S. manufacturing footprint, what are the critical factors that they need to consider to ensure that their products qualify for this accelerated depreciation, and what pitfalls might they want to be aware of?
Yeah, sure. So, the 100% factory write-off is brand new, right? That we haven't had that before. It stemmed from a campaign promise that Trump made on the campaign trail prior to him being elected. And it turned into this provision of qualified production property. And what it is, it's 100% write-off of your manufacturing plant that's associated with the manufacturing or production activity. And so it's not the entire plant, right? There's parts of your plant like offices or sales areas or engineering space, your parking lot. There are things that do not qualify as manufacturing. We're going to have to wait for guidance on some of this stuff, like warehouse. Is that directly attributable to your manufacturing, or is it not? Are they going to allow support related activities or support related areas as part of this or not? My guess is not, because it's specifically stated administrative and office and other spaces that have to be excluded. So what that tells me that there's still need to come in and do a segregation of your building, right? And so I identify, here's all the manufacturing space, the 100% write-off, and then here's the non-manufacturing space. Here's my offices, here's my engineering area, here's my quality lab, etc. And so I analyze that to see, well, maybe some of this qualifies for the 100% bonus depreciation, the provision that we just talked about a few minutes ago. And so there's still the potential to write off a big chunk of that building. It's just not going to be 100% of it. Couple pitfalls to be aware of. If you use tax-exempt bond financing for that plant, you're not eligible, because you're required to be now on the alternative depreciation system, and you're not eligible for the factory write-off. You still might be eligible for some other provisions that might accelerate some of those deductions, but generally speaking, you're going to be forced on the ADS and therefore not eligible for this new write-off. You have to be substantially transforming something. So there's going to be probably some guidance and maybe even some case law on assembly type operations. So if I manufacture it overseas and I assemble it in the United States, is that manufacturing, right? Does that fit? Does that fit the definition? I think it does, because I've got a substantial transformation, but the Treasury Department, of course, is going to give us their opinion on that. And speaking of Treasury, the guidance they're going to have to issue is around things like tangential property or an addition. So if I'm going to go put an addition on the building, well, maybe I want to just build a building right next door because now it's a brand new building and I get the factory write-off. Related parties. Oftentimes our clients have their operations in maybe an S corporation or a C corporation, and they rent their building from a related entity. They put their building in an LLC for asset protection purposes, and they're leasing that building to the manufacturing operations. If you read the letter of the law, only the taxpayer that is doing the manufacturing gets that write-off. The key is how are they going to define taxpayer? Is the taxpayer all the related parties? Because if so, I win and I get the write-off. If not, then I got some structuring issues that I need to start thinking about and think through. And so there's, the jury's still out on how Treasury is going to weigh in on this. But from what I'm hearing, they're issuing a lot of guidance this month. We already got something on one of the energy credit provisions on when has construction begun. Tim referenced the Section 179D and how construction had to begin by June 30th. There used to be safe harbors for that rule of 5%. 5% of my costs have been incurred, therefore I've started construction, even though I maybe haven't broken ground or picked up a wrench yet.
Mm-hmm.
Now they've changed that and said that you really actually have to physically start moving dirt or something along those lines in order for construction to begin. And so that guidance is going to be really, really important. And this provision is one that's going to need quite a bit because it's brand new, right? And they didn't write the law for every single different type of business. And so Treasury is going to have to issue some guidance here.
And one point on this related to kind of this, kind of the machine builders or system integrators as well is, you're kind of building something in your kind of warehouse, right? And when it's empty, it moves out. So that it would be that same point that Mike makes of whether or not, how does that guidance work on that? And if you're building, basically a new warehouse, as he said, and that's where you're building these new assembly cells, does that qualify as manufacturing? That will be an interesting thing as well. So kind of stay tuned and hopefully we'll have some guidance here shortly to be able to help our clients and the system integrator industry out there right now.
The shift now from earnings before interest and taxes to include depreciation and amortization for calculating the business interest deduction limit. This significantly benefits capital-intensive manufacturers. Can you kind of elaborate on how this change might influence an OEM's decisions around financing these new projects, managing debt, or even considering mergers and acquisitions?
Yeah, sure. So this provision was born out of the Tax Cuts and Jobs Act of 2017 and was effective for tax years 2018 and thereafter. And what it said is you're not just going to be allowed to deduct all of your interest expense without any limitations going forward. And so the way the calculation works is you first net your interest income with your interest expense, and you take that net interest expense amount and you compare that to 30% of your adjusted taxable income. That adjusted taxable income amount is determined by your taxable income plus depreciation and amortization. That was the rule essentially for 2018 through 2021. And then they had this revenue raiser in there that it automatically got rid of the depreciation and amortization add back in tax years 2022 and thereafter. And so for tax years 22, 23, and 24, we saw a lot of our clients' interest expense limitations. To your point, Mike, if they were leveraged, had significant amount of debt compared to taxable income, or if the reason they weren't limited before is because of the depreciation and amortization add back. If I'm buying a lot of capital equipment and I've got a significant amount of bonus depreciation, adding that back to taxable income to determine what that threshold is going to be is going to have a really, really significant impact. In addition, from an M&A perspective, let's say I'm going out and buying companies and I'm not buying stock, I'm buying the assets, right? If I go have a $15 million asset purchase and I allocate, let's say, $6 million to specific assets, and then I've got this goodwill, right? The $11 million of goodwill, actually $9 million of goodwill in my example, that gets capitalized and then amortized over a 15-year period under Section 197. Now all that gets added back. So it really was kind of a penalty for companies that were highly leveraged, that had a lot of debt, but not a lot of income. And so they weren't able to utilize those deductions. Well, now in tax years 2025 and thereafter, I get to add back the depreciation and amortization. It was made permanent, so I get to add that back. I guess I got to put an asterisk on that word permanent. Permanent is only as good as the next Congress decides it's where the word
Right.
permanent is.
Right.
I would say, you know, the one other thing, as Mike was talking about that, you guys mentioned the M&A, like in the controls area, the machine builders, the system integrators, there's been a lot of M&A. So as Mike was talking about, there was a lot of very high multiples that some of these companies were bought for, right? And the allocated goodwill would have been substantial, and therefore that amortization wasn't getting added back, and so there was limits on some of that stuff. It also hurt the really the sellers didn't know everything as well. You know, if they'd roll over equity or different things like that, there could be some issues with it. Now it makes it much easier to, at least, as Mike said, right now it's permanent, but hopefully this stays and makes it easier for everyone.
You know what I'm excited to learn is what Treasury believes the nature of the catch up of R&D expenses is going to be, the nature of that expense. So if I've got that, if I've got $3 million that I get to deduct in, let's say 25 or 26, let's say I'm over 31 million and I got $5 or $6 million to catch up, to deduct my unamortized expenses. Is that a research expenditure or is that an amortization expenditure? Because if it's an amortization expenditure, now I get to add that back in determining my interest expense limitation. If it's a research expenditure, I don't necessarily. So it'll be interesting to see the nature of how Treasury treats that deduction.
Do you think, Mike, that there will be guidance on that item?
Well, I think they're going to issue Treasury regulations that are proposed in nature. Then geeks like you and I will write some comments into them, and hopefully they address those in the final regulations. But I think it needs to be addressed, right? It'll be dependent upon when they issue new rules under methods of accounting under 446 or 448.
Well, you had talked a little bit previously about ownership structures, and Lord knows there's many different ways that a lot of these organizations are structured, but many OEMs, they operate with very complex ownership structures, including flow-through entities. And beyond the immediate tax savings, how do the permanent lower individual tax rates and the QBI deduction and the adjusted SALT cap impact long-term strategic planning for privately held or even family-owned OEMs, particularly concerning succession?
Across the board, the individual rates were I shouldn't use the word cut, but maintained, because the Tax Cuts and Jobs Act cut all these rates down to 7 different tax brackets, and the top one being 37%. And it also introduced Section 199A deduction that took that 37% down to 29.6%, because I get a 20% deduction related to my domestic manufacturing, 20% of my taxable income. Well, that 37%, then taking 20% off to 80% of the 37%, gets me to a top rate of 29.6. So all that was made permanent, right? And so that was the relief, because in the event that we didn't have congressional action, everybody would have gotten an increase in tax all across the board. Every single tax bracket would have increased. The rate would have went from 29.6%, which is where we're at, to 39.6%, because the top rate would go from 37 to 39.6. Plus, there wouldn't be the 199 flow-through deduction anymore, because that was set to expire as well. So this extension really kind of added some asterisk permanency to those tax rates, right? And you couple that with the larger standard deduction, which was made permanent and indexed for inflation, the repeal of the personal exemptions, the increase of the SALT $1,000 to $40,000. Those sort of things, and that's only a 4-year period, 25 through 29, and they're going to have to address that SALT cap again. And so you put all of that stuff together, and it was a significant reduction of individual income tax rates. And as we talked about earlier, S corporations and partnerships pay tax at the shareholder or the partner level. And if let's say Tim and I own a company 50-50, we're an S corporation and it makes $1 million. Each of us pay tax on the 500,000, regardless of whether the S corporation gives us cash to pay the tax or anything like. We pay it on the income of the company, right? And so, in that example, that 500,000 would be subject to the tax rates. I'd get the flow through deduction and so forth. And so it was a significant non-change, I should say, because it basically continued the policies that the Trump administration started in his first term.
A couple things that I'd add to that, I mean, you talk about OEMs and large, but I have some smaller clients that have multiple owners to some of this stuff, and that the $10,000 salt cap before definitely hit with property tax and basically a little bit of income tax, right? And so a lot of the states were doing pass-through entity taxes. Michigan in particular did one, and it became a little bit of a pain because of Michigan, how it was set up, and some extra work on some of that. And so we would set that up with some of the clients, and you'd have to make quarterly payments and different things like that. Well, now for some of those guys, the 40,000 is plenty, right? So now with the 3 owners or 4 owners, they're not going to be over that threshold of 500,000 a year where it starts to cap out. And so it makes it easier for them. We're not going to have to do a Michigan pass-through entity tax, right? So it has some savings in doing that tax return, as well as just kind of looking at it and simplifying their return. I mean, it a lot of these things we talk about the big companies, but we're doing, Wipfli does clients that are in that $5 to $1 billion, and so you really kind of look at some of the benefits that's doing for maybe the smaller ones that aren't making as much money.
Getting back to the article before, it mentions other OBBB provisions that affect manufacturing planning and operations, including tax adjustments and new reporting standards for employee overtime, the international tax adjustments, and then the employee overtime. For an OEM with a global supply chain and a diverse workforce, which of these less highlighted provisions warrant their immediate attention, and why would that be?
Well, we've already covered one, and that was the energy efficient building enhancements, right? That kind of flew under the radar that they were getting rid of that. So if you're considering energy efficient lighting or something along those lines, then it makes sense to start that sooner than later, because that benefit expires. You mentioned overtime reporting, no tax on overtime. That's a little misleading. It's no tax on overtime up to $25,000, $12,500 if I'm a single individual or head of household, but $25,000 if I'm a married individual. Well, the IRS has come out and said, hey, look, we're not going to change the W-2 this year. So business owners, you need to be able to calculate and provide that information to your employees, because they're going to be asking you for that information, because it's not going to be on the Form W-2. The payroll companies aren't going to be required to put that on there, because they're not going to change the form this year. They're going to wait to next year to change the form for this provision. Same thing on no tax on tips. Not that has a oversized impact on your listeners, right, and readers. But the no tax on overtime does, and it's retroactive to January 1. So I have to go back and calculate, well, what were those overtime amounts that were paid to my employees? So in my example, I have $100 of overtime that week. I need to provide that information to my employee, because he's going to get a deduction. He or she are going to get a deduction on their tax return related to that overtime, that qualified overtime pay. And so, other things, they expanded Section 529 plans. So if you've got employees that are going through apprenticeship programs, or other certifications, welding certifications, those sort of things, those all qualify for Section 529 plans now and can be paid out of those 529 plans, and you get some growth tax free. Family leave, employers that are paying for paternity leave or maternity leave or other medical leave, that there's a tax credit for that as well now, and that was made permanent. Student loan repayment. If you're paying your employees student loans for them, you get to deduct up to $5,250, and that was made permanent. And they don't pick that up as income. So it's a nice benefit or perk that you can provide to your employees that might have student loans. The methods of accounting provisions weren't touched. I was worried about that because if I'm under $31 million of average annual sales, I can be on the cash basis of accounting. And that's huge. Let's say I'm a $25 million manufacturer and my receivables are $3 million and my payables are 1.1 and I've got $400,000 of customer deposits on hand. So my liability side of the house, payables plus my customer deposits, 1.5 million. My receivable side's 3 million. Well, if I'm accrual basis of accounting, I picked up that $3 million in income already. I got the benefit of the 1.5 accrued expenses, but I got to pick this up in income now. If I'm on the cash basis of accounting, I don't have to pick that up in income until I get the check from my customer. So in my example of that $3 million versus the 1.5, if I switch to the cash basis of accounting, I get a deduction in the year I make the change of $1.5 million. That's huge, right? And then I'm going to recognize cash basis the remainder of the year. There was talk, in fact, it made it into the House bill that threshold of 31 million was going to make it up to 100 million of average annual sales. That did not make it in the final version. It was not part of the Senate bill that the House passed. But it's something we're watching because I think, well, this might be a little bit of rhetoric, but Jason Smith, who's the chairman of the Ways and Means Committee, and Speaker Johnson have both said that they're expecting to have a second budget reconciliation tax bill this year to cover some things that didn't make it into the first one. I'm hoping that's one of them.
On that point, the 31 million, it's an average 3-year gross receipts of the prior 3 years. So, if you jumped up to 50 million this year, you could still be able to utilize it, for another year or so as well, because you're looking at your average 3 years. And even if you haven't done it and you're getting past that thing, if you do it in the current year, if you were 50 million and you still qualified, you'd get that deduction in the first year. And then when you had to switch back, you would pick up that income over a 4-year period rather than that first year. So, it's got it definitely has, some benefits, especially when you're trying to look at how do I expand, how do I make money, how do I not pay taxes right now? And, it's a huge opportunity.
Then given the combination of opportunities and complexities introduced by the OBBB, what would you say are the top 2 or 3 actionable steps that every U.S. OEM, regardless of size, should take now to maximize the benefits of the legislation and position themselves for not just current but long-term growth?
I think we'll start back to the first question you asked, and that's R&D, right? I mean,
Right.
It's if you're doing design and development related activities, I'm developing or improving a product or a process, and I'm eliminating design uncertainty through modeling, simulation, or trial and error. You're building prototypes, you're testing them, making changes, those sort of things. It probably has some significant R&D expenses, and the R&D tax credit is really rewarding, and you don't have this punitive requirement to capitalize your research expenditures anymore. And so I got the sense and the feeling from our clients over the last few years that they've been a little cautious for including superfluous or other type of expenditures in there that if they could argue that it wasn't research, they would argue that it wasn't research because they didn't want to capitalize the research expenditure. I think that'll change now. I think the pendulum will swift back towards a, hey, look, let's invest in R&D and it aligns with the kind of the purpose of the bill and investing in U.S. manufacturing. And that's the other provision that I think is so important. And that's the capital projects, the combination of bonus depreciation, the qualified production property, Section 179 energy efficient buildings deductions, and Section 179 in general, just to be able to write off all these assets. And it really encourages investments in the United States because you got to do something to offset some of these tariff costs, right? And so this is kind of a balance, I think, between the two to try and just keep U.S. manufacturing more competitive, regardless of where they're getting the raw materials.
Just, adding on to, what Mike said about the U.S. manufacturing, right? On the R&D, we talked about, you don't have to capitalize anymore. However, if you're doing foreign R&D, you still do need to be capitalizing that foreign R&D and amortizing that over a 15-year period, right? So the incentive of this bill really was, trying to figure out how to bring back U.S. manufacturing in some of that. And yeah, it's, I think for the capital projects, they've moved that out to, you got to start it by, I think it's 2029 or 2030, so it's giving you some time to do it, because you just can't start a project tomorrow and have it done, right? And you just have to have it kicked off to be able to do that. So
Great. So anything else that machine builders should be aware of regarding this new legislation?
I would say that one of the key items that I look at, especially with a lot of the machine builders and system integrators, is they're looking at the future, and when is the time that they're thinking about selling. The estate tax was made permanent at 30 million, as a married couple or whatever, but we're still seeing a lot of clients that are selling for, potentially well over that $30 million, right? Depending on their size. And, with some of the hiccups in the, in the manufacturing industry this year, there's a huge opportunity for, as you talked about before, succession planning, maybe gifting, and looking at, the value of the company may be well below that 30 million right now. When you do evaluation when you got minority discounts or marketability type things, where you could look at gifting some stuff to your kids or to other people or different things like that. Looking at that succession plan is a super important part of this. Even though the cap went up to 30 million, it's still, this is an area that if you plan early enough, you can really save money on the back end for your heirs. And I think a lot of people don't think about that as much, because and some people are like, what, if I die, they're responsible for that tax, right? It just depends on the type of person you are and how you want to plan for it. But I think that's a huge opportunity.
I think we could have this conversation 6 months from now, and you'd have more details and more guidance and so forth, and manufacturers will have a little bit more information at their fingertips so that they can plan a little bit better. And it's, you got to be patient with Treasury and them issuing their guidance and so forth. But got to tell you, we're starting to get guidance quicker than we ever have before, and they're really on top of it. Despite the fact that Treasury and the IRS are short-staffed right now, they're putting priorities around getting information out to taxpayers about this new law, because they want to be successful. And so Congress is putting pressure on the Treasury Department. Of course, President Trump is putting pressure on his own administration to get this guidance out quickly, because he wants to control the narrative as much as possible. And so I'd say watch for guidance out here. Talk to guys like Tim and I, because there's the devil's in the details, and you want to make sure that you can get the most out of this bill, because that's what it's meant to do. It's meant to make you more competitive here in a global manufacturing environment.